Hello, here we are to look on to what is called Solow Growth Model. Let's proceed with the same. To begin with, there was a very famous economist called Robert Solow. And this person was actually giving his idea of economic growth almost in the 1950s, and his model of growth or his model of economic growth has got so much of kind of differences with what we have already learned in the name called Harrod-Domar model. So Harrod was proposing the model, again Domar was giving his interpretation. But when we look at both these models, we could find that both these models were having some similarities, and that is the main reason we call these models together as Harrod-Domar model, isn't it? So coming to Solow's model is identified to be something called a neoclassical growth model. And this model emphasizes what is called growth in terms of a long run. So what is long run? Long run is a time period that we consider so as to have some changes in the economy. So we can bring about changes in all the factors, irrespective of whether it is a fixed factor or variable factor. So this is a basic understanding of a long run scenario. So everything is flexible, everything is variable, isn't it? Now coming to Solow's interpretation of economic growth, Solow was giving some more stress, or he was actually highlighting or stressing certain important factors that influence growth. So factors leading to growth. Factors leading to growth. So in that sense, we could find that he was giving emphasis to two main factors. One is called technological progress. So that is called the upgradation in technology. Upgradation in technology. So what does it mean by upgradation in technology? Upgradation in technology means some kind of technological improvement. So improvement in technology will be helping us to produce certain commodity with most efficiency. That means with less cost, we will be able to produce more output. With less factors, we will be able to produce more output. This is a basic understanding of technological progress. So the person Solow was actually giving us too much of stress to the idea of technological progress, and he was believing that when there is too much of technological progress in the economy, that will be leading to more and more growth. Again, this person was giving some emphasis to what is called capital formation. So what does it mean by this? So here, this could be attained with something called investment. So if there is more investment in the economy, there would be more growth. So Solow thus was having some similarity kind of understanding or interpretation with Harrod and Domar, but it doesn't mean that Solow was completely supporting Harrod and Domar. There existing some kind of differences between these two models also. Now, coming to the assumptions that has been followed in this particular Solow model. The Solow model was always based on what is called constant returns to scale. Constant returns to scale. So what does it mean by this constant returns to scale? Constant returns to scale means that you're doubling the inputs. For example, if you're using two inputs for production, capital and labor. So if you're doubling both capital and labor, means the output itself will get doubled. So the output will not be less than double or more than double. Exactly it will be equal to double. So doubling the inputs will be making us to have some kind of opportunity to have doubling of output. So this is the basic understanding with respect to constant returns to scale. And also this person, Solow, he was actually considering technological progress as something exogenous. So he believed that it's actually something which is not determined within. Instead, it's something which is determined outside. So he believed that this is independent of the activities of the economy. So that means this exogenous technical progress is something which is so special. This person Solow was not considering those endogenous elements into consideration. Instead, he was very keen in discussing all those exogenous factors in influencing production. Again, so coming to the production function used by Solow. Production function. So what does it mean?